Any chance that this cheery consensus could play out differently in that how it has in the past, Manish, simply because the one factor that is notably different, and I know it's foolhardy usually to say that this time it's different, but the one factor that is different since maybe the COVID lows is the consistent, recurring and increasing domestic flow, which is forming, which is helping the markets form a base much quicker than what has happened in the past.
No, it's true, Neeraj. What you say, these flows have been incessant. And in fact, if you had asked me this last year, I would have said this market is going to just go into an explosive bubble on the way up. And the melt up has surely been occurring on the small cap, mid cap side. One has also seen some craziness going on the FNO side of the market. We're already at 150% of GDP in terms of market cap, which is really the peak we hit in 2007. So all from those parameters, it's a bit giddy to be sitting where we are. The only happy note over here is that the large caps don't look excessively mispriced. We may be 6 months, a year ahead in terms of earnings, but let's say this market were 10-15% lower, everyone would be fairly comfortable saying let's come back and buy it again. And to be honest, most of the foreign investors have been waiting for that sort of pullback in the market without much success to come back in. So my best guess is if this market just stays where we are and we just tread water for some more time and we arrive into the next year at similar sort of valuations, I think everyone will be feeling a lot more comfortable. If, however, we do some of these policy things which were expected of India, such as on the foreign exchange front, such as on labor reform, such as on agricultural reform, and so on, and start getting this economic engine running a lot faster with lower inflation, then the deluge of money which is going to come to India from overseas cannot even be quantified. And then you have the classic makings of real acceleration, because you have domestic money continuing to come in through these SIPs and so on, plus, of course, the money which is coming through the EPFO and the LIC and so on, and it'll be supplemented by the foreign money. So until that happens, I would think the best course for us is really to tread water, and hopefully some of the supply response, which the corporate sector is doing by selling paper down into the market through primary issuances or QIPs, that hopefully just keeps a lid for some time to allow us to really grow earnings into these valuations, because we are ahead of what reality is currently.
Got it. And you reckon that the flows globally, or as the case may be, would be amongst many other factors also seeking the regulatory changes and the reforms that you alluded to, because some of these have been tried, half successful, given up, etc. It's a new term, 5 more years. You reckon the chance is the best to do it in the next 12 months?
No, Neeraj, like I said, it's a valuation thing that, at a certain price, you're pricing in a lot of perfect execution.
Got it.
If let's say this price was 15% lower, you would have seen a lot of flows coming in. Given where the prices are and given the slightly weakened mandate, the expectation that you can ram through things, which, for example, on the labor reform side or even on land reform side, on skilling and getting a lot of jobs getting created a lot faster, which will require ease of doing business, judicial reforms, and so on. So some of that certainly has become a little more tepid in I think, the overseas investors' mind. Having said that, I mean, give this market some time to correct on valuation, either time-wise or value-wise, and you'll certainly be surprised by the amount of strong foreign inflows that are waiting to come in.